right, happy Saturday. Today is July 17th. I'm going to share a screen so you can see my screen. Okay, July 17th already. It's already halfway through the month. So we have to get at least one deal this month. You going to help us, Sean, get one deal?
Sure.
You're going to
give a deal, guys. We'll fund it.
Give us the deal that the bar can't fund.
Oh, I don't know if you have any of those.
A deal where a buyer falls out. We'll take those.
There's some good ones in Hawaii, but it's because they're having like conflicts.
Okay. We're open to Hawaii. I need a reason to go there.
Yeah, for sure. We do too. You know, like if we fund it, we'll go there to see the site.
Nice. Okay, count me in. I'll volunteer. Free BPO. Okay. So welcome everyone. We are going to start, and we have a quick agenda for today. So first, we always start off some wins for the week. Just very quick, 5 minutes. Anything exciting, anything fun, or anything good, just any wins. We want to start out positive, and then we want to go over a quick market updates. We just like to see what's active on the market in Santa Clara County, since that's where most of us are. Live deal analysis. This week we're going to skip this because we're going to have our speakers talk more. But we can check out this one fat flip that we saw that just hit the market, and they bought it only like 2 months ago. So we'll check that out. And then I'm going to show you a little bit about Reonomy. Reonomy is actually a really good website to search for multifamily or commercial. So Reonomy is super easy. I didn't realize how easy it was. You just search, and then it has the number, it has their email, it has everything. So Reonomy is a pretty powerful tool to find off-market deals in anywhere. And then we're going to have the Q&A with Conventus. I have some questions, but it seems like Sean and maybe Julius, depending on how you guys want to do it. Sean says he has a quick presentation, which is perfect. And then Julius, we can do Q&A. And then we'll do Q&A together at the same time, so you can compare side by side the different products. So thank you, Sean and Julius, for joining on this wonderful Saturday. And then after our Zoom today, we're going to do some mailers. So I printed out a whole bunch of mailers already. So we got the letter, we got the proof of funds, we got the offer. So what we're going to do is we're going to stuff the envelopes. We just have to handwrite where it's going to. So everything is pre-printed. So anyone wants to join me today at 12 p.m. 12 p.m. we'll have a pizza and mailer party. So we're gonna try to send out a couple hundred today. Try to hit Paso Robles. We're hitting Paso Robles now because we like the wine country, and it's a good Airbnb type of area. And if anyone wants to read the news, this is interesting. Markets that are turning right now. So what type of markets are turning, meaning that it's not appreciating or it's depreciating. So you don't want to be flipping in these top negative markets right now. So ugly markets, that's what they call it. So go ahead and read that. The link's in the Google Chats, and I will share the good chat with everyone, or not Google Chat, Google Docs. Let me share this with everyone so everyone can see. Let's see, share with everyone. Anyone with the link, I'll put it in the chat room, and you can also edit and type notes and things like that. Okay, so chat room, where's the chat room? Here we go. All right, so a lot of new faces. This is good. Very good size group. And okay, upcoming events. I'm gonna be speaking in Livermore. If you guys want to hear me speak, we'll talk about house hacking, flipping, and the future of investing for us. We're going to share some of our stories, some of our lessons, some of our mistakes, and how not to lose money, because we lost money in real estate. So it's not always positive. Sean has a good story too. You want to hear Sean's story?
I have many stories. I won't be there. I'm going to be in Florida.
That's right. Okay, so... And then Speak Easy event with Arlen Chu. He's setting up this huge event. It's going to be like 100 people.
Canceled?
No! No, I was looking forward to meeting everyone. Okay,
no.
Plan
Maybe
B.
Postpone till next time.
Plan B. Okay, so SARE has an event, but it's very limited in San Francisco that same day. And then we're gonna have an event with Diana George on August, the first week of August. We're gonna talk about design, construction, flipping. She's done a lot of flips, and now she designs high-end remodels all over the Bay Area. So we're gonna have that first week of August. So feel free to cancel all of your plans for August and join us. This is more important. You gotta learn how to design a $1 million house. Okay, so quick wins for the week. A couple of my wins. I want to show you Reonomy later, but it's really nice, really easy. It's so easy. Maybe I can even call a seller too. Jeremy is getting some leads from real estate agents. So Jeremy has been pretty active. He's been calling real estate agents. He's been texting. He's been reaching out, and we actually got a few good leads. So one in Pachecho. We can't share just yet because we're waiting to get the contract. We want to get it around like 600, and it could hit 750. Quick remodel, 50 grand remodel, in and out. And then Palo Alto is interesting. That's gonna be around like 2.3 to 2.5. It could hit maybe 4 million new construction or 3 million just remodel. So it's very fascinating, very expensive though. So I'm not sure how to put that together. But he's getting deals, we're getting leads. So very, very productive week. I'm gonna start a new marketing campaign with mailers again. I really like the mailers because it's more customized and quick. Anyone can just write a mailer to a house in like 5 minutes. But now you have to think how to scale that. So first, we're just doing a few hundred for now. But think, how can you do a few thousand? And then Don Costa, he was at the meetup with Dean. He does 1 million mailers a year. So how can we get up to that type of level to do 1 million mailers? And then, oh yeah, we checked out a $30 million flip of Conrado in Hillsboro. That was fascinating. So this guy's gonna put in like 18, 20 million. I don't know how many millions, but the foundation alone was already like 2 million. So it's some pretty fat flips out there. And he's gonna sell it for 30 million. So very impressive. 10,000 square feet, like 2 acres. Okay, so any other quick wins? I want to hear about you guys. Any quick wins for the week? Anything exciting? Anyone
Yeah, I got one.
Yeah, nice. What you got?
That Oakland deal that I was working on, it's got a pretty hefty rehab. We found a experienced contractor who used to work for the city of Oakland, actually, and we went to the city yesterday to view the building plans and everything.
Yeah.
And everything went pretty well. So it looks like, as long as no crazy surprises happen between now and 2 weeks or so, looks like that deal should be closing. So
nice.
That's solid progress, because that was a pretty hard one to find a buyer for.
That was, yeah, because it was small lots, but you found a buyer.
Yeah.
And then that's quick money, right? Quick income.
Yep.
Nice. Congratulations.
Thanks.
So party at your house next week?
Yeah, we can count on that.
All right, barbecue at your house. Let's plan it. Okay, that's very good. Very good job finding a buyer. That was a tough one because not many people can take on a huge remodel like that. So very nice on that. Anyone else have a quick win, and then we'll move on to our market updates. We're gonna rush through very quick. Quick win. 5 minutes. Anyone win the lotto? Anyone got married? Anything exciting? No one's getting married.
Anybody got divorced?
Anyone? That's also a win too. Bill Gates
if you got divorced, do you want to sell your house?
Let's send a mailer to Bill Gates. I heard you got a divorce. You want to sell your house, and let's try it.
I'll give you a real quick win.
Yes, Dean, quick win.
Yeah, I went on I talked to this one family. They were selling their parents' house. I've been talking to them for about a year. But anyway, long story short, they had the resources and money to just sell it retail, listed. So I referred an agent to them. They liked them. Just closed a week ago, and I got this is just a referral check. I got a referral check for $28,000.
What? $28,000?
So if you don't buy the property, try to get them, if they're clearly a retail lead, then obviously you want to have a good agent, someone who can close on them too, right? If they can't list it, if they're not good enough to get the listing, then there's no referral check.
Nice, good job. 28,000. That's amazing. That's like a wholesale fee right there.
That's pretty cool without having to do a whole lot of work.
Yeah, and then the catch to this is you have to be licensed. You have to be licensed to get a referral check, unless you get cash or bitcoins or gold. But you have to be licensed if it's broker related. So very good. So that's another reason to get your real estate license. You can get leads, get referral checks, things like that. So very nice. Thank you for sharing your wins. That's pretty exciting.
Dean, how much is the house was sold for?
I think it sold for like 3.6.
Wow.
Great.
3.6. That's affordable. Wow, good job. 3.6. So now we're gonna check out the real estate market. Who wants to check out the real estate market? What's going on in Santa Clara County? Is there gonna be a shift? Everyone's saying there's not a lot of multiple offers, but then you ask another person, they got a whole bunch of multiple offers. So I don't know what's correct. Is there not a lot of multiple offers, or there's still? I think the market's still pretty good because of inventory. So let's check out the inventory. So let's see here, Santa Clara County. We're just gonna look real quick, just 5 minutes. Santa Clara County. Every week we're gonna see if there's a change. So active property is single family active in Santa Clara County. Let's see, how many active? Anyone wants to take a guess? How many actives in Santa Clara County?
700.
1,200. That's close. It's 12 or 1,041 right here, 1,041. So it's kind of similar numbers every week. I'm not sure why it's so similar every week. 256. It's very similar. It's like right there. Pendings. How many pendings right now in Santa Clara County? Pending. Yeah, 1205. So there's still more pendings, right? 1205. Still more pendings than actives, which is good. How about under 1.2? 331. So just about the same. It's not moving or anything. It's kind of similar. So that means there's still very low inventory in a way, right? Only 1,000 actives on the market. How many solds this last 30 days? How many solds? It says 27 sell dates. Let's do this. Sold within the last 30 days. 38. That's not that many. I think there should be more. 347. That sounds about right. Yeah, 347. That's a big jump from last week, right? 347 sold. So a lot of houses are selling, but maybe it went pending a month ago, right? So the market changes very quick within a month or two. So how did those sell so many, right? How did so many sell in 30 days? I'm not sure. But the actives are still the same, not much going on. Not a lot, right? Not a lot of inventory. So until we see more actives than pending, then we'll be a little bit more worried. So let's see when that happens. Anyone wants to make a gamble? Is that going to happen this winter? More actives than pendings? $5 gamble, anyone? $10? $100? $1,000? $1,000? More actives or more pendings by December 2021. Anyone want to make a bet? Side bet. $5. It'll be fun. $5.
Yeah, $5.
Okay, Tam. Tam's in over or under? More pending or more actives by December?
More active.
More actives by December. Okay. All right, Tam.
I'll take that.
We got witnesses. Let's see if I'm gonna make $5 on December 1st of 2021. I really want this $5 and buy some boba. So thank you, Tam. Let's make this bet. So let's see. Okay, so fat flip. We're gonna check out this really quick fat flip since we didn't look at leads this week, and then we're gonna roll on over to our speakers since we don't want to waste too much time. So check out this fat flip, and every time we see a fat flip, try to learn from it. Learn how much they bought it for. Learn what was the seller criteria. Who was the seller? Why did they sell? Where was this area? Try to question all that. So this is a pretty nice, super fast flip. So let's see. They bought it in April. They bought it in April. So April, May, June, July, 3 months, right? Only 3 months. 3 months, and then they accomplished to remodel this whole house, front yard landscaping, beautiful paint job. It's just a really nice house, well put together, right? Nice detail. Look at that, nice siding. So $790 was their price. $790. They listed for $1 million, but that's just a teaser price because 95128 could hit very high. So I'll show you the comps for 95128 just around here. They could probably hit 1.3. So look at those numbers again. They bought it for $790. Let's just say 800. They bought it for 800. How much is that remodel? How much do you think is that remodel? Pretty nice remodel. Nice remodel on a 1,300 square feet house. Let's say 100 grand. 100 grand.
Yeah, 100 grand.
Maybe 130 with the landscaping. So 130 with the landscaping. So they bought for 800. Put in 130. That's 930. 930. They're gonna sell for 1.3. Look at, yeah, it should sell. I think it should sell for 1.3 because 95128. It's hot. So here's all the houses around 95128. Quarter mile. This one sold for 1.3 last year, right? So can they hit 1.3 this year? What do you think? This is last year, 1.3, single story.
They can because of the square footage is much bigger.
Yeah, ours is 1,300 square feet, right? 1,300 square feet. Yeah. So I think they can hit 1.3. Worst case 1.2. So let's look at those numbers again. 800, put in 100. Let's say round numbers. 800, 100, 900. 900 sell for 1.3. That's a big spread. That's $400,000 difference. And let's look at these ones. I wonder why these are so low. So, but there's nothing active on the market right now, right? There's only one active for 1.8. And then this one is that one, Rutland. And they got it on the MLS. Oh man, that's so sad. How come we didn't buy this, Mr. Dean? It was just sitting on the MLS for us. On February. Where were we in February? How come we didn't buy it?
How many days on the market?
Just 6 days on the markets, and it's a different agent, right? So the agent didn't double end or anything. Different agent, different company. So they just got it. Yeah. And they only went over by 5,000. That's amazing, huh? So you could get deals on MLS, and you don't have to go to the listing agents. So let's look at the tax record. What type of seller was this? Why would this seller sell in a hurry? This is the corporation that bought it, the flipper. Look at the previous seller. The previous seller is Mahan Rosalie, and they bought it in 1998. So that hits our criteria. 20 plus year ownership, right? 20 plus year ownership. That's what we really like. 20 plus year ownership. Riverbend Financial, hard money lender. Who is that? Sean, how come you didn't get this loan? Come on, Julius, you didn't get this? Who's Riverbend? Is that our competition?
Riverbend does like new construction and commercial loans. I have a buddy that works there, Dane Fitch.
Oh, okay. Yeah, so they're funding flips too, huh? Riverbend. Interesting.
Yeah, they'll do them.
Yeah, very interesting. I wonder what their terms are. But we'll talk about terms, and we'll talk about hard money right now. So this is a perfect rollover to hard money. So check out, so remember that the fat flip, remember those numbers. Always try to remember the numbers. 800K remodel, let's even say 150, just bump it up like crazy. So 950K, sell for easily 1.2. That's a $250,000 gross, right? 5% closing costs. Closing costs on 1.2. That's, let's say 60K. So they're gonna make easily 150K nets after hard money and all that. Nets, right? 150K nets in like 6 months, 3 to 6 months. It's not bad. And they got the deal in the MLS. So how did they just get the deal with MLS and paid 5,000 over? That's crazy. That's amazing. So congrats to them. And then this is some random real estate I just want to share for fun. So Ivanka Trump and her husband Jared just bought a $24 million house in Florida. So that's fascinating, and you want to see what their house looked like. But think about the numbers. So 24 million in Florida, you get this nice fat house, right? You get a nice fat house, and it has a backyard, 1 acre. But in Hillsborough, the house was 30 million. The house was 30 million, but it had no backyard. It had no backyard, right? So compare the numbers. Would you want Hillsborough 30 million, or you want Ivanka's $24 million mansion in Florida? What do you guys want? So even rich people know where to spend their money. Even rich people buy out of state because Hillsborough is expensive. But maybe people are in Hillsborough for a different reason, for business, for work, their company. So it just all depends, right? So 24 million, I think we can buy that. We'll all pitch in and buy this 24 million house together. We can live right next to Ivanka.
$1 million each.
Yeah, $1 million each. That's not bad. Everyone get a room. I'm gonna live outside by the swimming pool.
Oh gosh.
All cash. Can you fund this, Julius? 24 million? Fund it for us?
No problem.
Awesome. Okay, so let's go into our hard money session. I have questions, but maybe Sean and Julie, if you guys want to go over some slides, if you want, up to you. But I'm gonna go over Q&A. So Sean, let's do your slides first, real quick, and then we'll go Q&A. So, and then we'll compare
sure.
side by side. Let me make you co-host so you can share your screen and all that.
Yep. Oh wait. How long does your meeting last usually, Tom?
Usually till 11, but we can go a little longer if everyone wants to stay longer. 11, 12, 1 p.m., 2 p.m. As long as you guys like. I have all day. I have nothing to do today besides mailers.
All right, let me know when I can share my screen.
Okay, go for it. I just made you co-host.
It says host disabled participant screen sharing.
Oh. Oh, make co-host. Okay, I have to press accept.
There you go.
Okay, there we go.
Okie dokie. Let's see here. Can you guys see it's okay?
Mm-hmm.
Yes. Okay, so what's going on, everyone? I know we're kind of short on time, so I'm going to try to blaze through this presentation, but this is kind of like a general overview of how hard money loans work. So for those of you who are brand new and don't really understand it, then this presentation is great for you. So this is just going to be like a one-on-one on it. For those of you who don't know me, my name is Sean Pan. Like Tom and Dean, I'm also a real estate investor based in the Bay Area. I'm also a hard money lender with Conventus Lending. I also do podcasts and YouTube. So if you guys want more real estate investing content and you don't want to wait every week for Tom's great meetups, I encourage you guys to check out the podcast and the YouTube channel. And I also do host my own meetup groups as well. We usually meet up twice a month, virtually for now, but we're going to possibly meet up again live in person once I get back from all my vacations. So in general, what is a hard money loan? So hard money loans are loans that are based on the hard asset, so the actual house, instead of your borrower credit worthiness. So, we don't really look at your debt to income ratio. We don't look at your tax returns, W-2s. We want to make sure the deal is good. There's two types of hard money loans that we're going to talk about today. One is your bridge loan, which is a typical hard money loan for fix and flip projects. These are short-term loans, 12 months, usually interest only and with higher interest. And then we also have this newer program called the long-term rental loan. So these are 30-year fixed loan programs for people who want to buy more rental properties. A hard money lender like Julius and myself, we are going to be somewhere between institutional financing and private money. So what I mean by that is with private money, it could be your friend, your rich uncle, and as long as they trust you, they don't care. They'll just give you the money and they're not going to do any crazy underwriting. Whereas for institutions, they want to make sure the deal is really good. So they do a lot of appraisals on it. They look into your financials. So we're somewhere in between because we still do underwriting, but we're also flexible with our terms. So in today's presentation, on the bridge side, we're going to cover some common misconceptions, who should be using hard money loans, process of getting a loan, some documents that you need, the construction loans, how they work, cost of doing a hard money loan. On the long-term rental loan side, we're going to talk about the types of long-term rental loans, prepayment penalties, debt service coverage ratio, and what that means, how to calculate your rate for the long-term rental loan program, the limitations for this program, what seasoning periods are, and how to get cheaper loans. So again, this is a lot of information. Thank goodness you're recording it. If you have any questions, just go back, watch it again, or schedule a call with me and we can go over it in more detail. All right, so for bridge loans, common misconceptions. Some people think they can get 100% financing from a hard money lender. In general, most hard money lenders will not give you 100% financing. Even if the deal is super good, generally speaking, the highest LTV they're going to give you is 90% of purchase and 100% of the rehab cost if you're experienced. If you're new, I know for our company, we try to keep you at the 80% range for purchase and 80% for rehab. But the more deals you do, the more repeat business you do, then we can open up the terms. So misconception number 2, you can get a private money lender to cover all the down payment and closing costs. So again, in general, most hard money lenders don't like that. Of course, as you become more experienced, like Dean and Tom, then maybe you can start doing that. But if you're brand new, they don't want to see that you're having just another person come in as a second lien position to cover your entire down payment. They want to see that you have some skin in the game. But what you can do is you can partner with the money lender and say, hey, your portion is to come up with the money and we'll come with the deal and the financing and we'll split this as equity partners. But by putting that private money lender on the loan, they're also a co-guarantor. So if anything happens, then we can also get money back from them. All right, number 3, some people say credit doesn't matter if you're getting a hard money loan. So if you're going with like our companies, like with Julius and myself, our rates are pretty competitive. We're going to be in like the 8 to 9% range and 1 to 2 points. We do credit checks. We want to see that you are above like a 620 credit score. We want to see if you don't have like fraud or bankruptcy in your background. There are hard money lenders out there that will give you a loan, but they'll probably charge you like 15% and 3 points. So just keep that in mind. And number 4, appraisals are needed for hard money loans. So that also depends on who your lender is. I know for us, we do require internal appraisals for the most part. All right, I'm gonna chug my water bottle, by the way. This is 8 cups in 1 bottle. So drink this one time and you know that you're good to go. All right, so when should you use hard money? Hard money loans are great if you can't qualify for conventional financing. For example, if your debt to income ratio is too high. I'll give you my example. When I first started flipping houses, I had a job as an engineer, making a solid 6-figure salary. But I already had a loan for my property here in Milpitas and had a lot of loans for properties out of state. So a normal lender like Chase or Wells Fargo is going to look at someone like me and say, hey, you already have too many loans. You don't qualify, sorry, and they won't give me a loan. Even though this deal I had was super, super good, they wouldn't give it to me. So that's why hard money loans were available for me to then buy this property, flip it, and make a huge profit. The second reason is if the property condition is too poor. So Tom has a friend named Alex, and Alex had this beautiful property in San Jose, but it was like not in good condition, right? They had to fix everything. The bank spent 30 days wasting his time getting appraisals, even though there was like no kitchen and stuff. And they said, look, your property condition is too poor. So then they couldn't do the loan. Whereas for hard money lenders, again, we look at the deal. If the deal's good, we don't care if you're missing a kitchen, missing a bathroom, we can do the loan. And finally, if you have too many loans, if you have over 10 loans, then the banks are just going to cap you and they're just not going to give you a loan. That's how it is. So these are some of the main reasons why you wouldn't qualify for conventional financing. Another reason you'll use hard money loans is if you need to close quickly. Like I mentioned before, a regular bank would take 30 days, maybe 45 days. I sold the property, it took them 45 days to buy my property. It really sucked. So for us, we can close within 10 to 14 days. For really experienced borrowers who we do multiple business with, we can close as fast as 5 days. Also, hard money loans are great if you need more leverage. So conventional financing usually limits you to 80% of purchase, even if you're super experienced. Whereas for hard money loans, we can give you up to 90% of the purchase price. And we also provide rehab funds. So getting a conventional loan, you probably won't get rehab funds for the most part. But hard money loans are not for everybody. So we can't do this for owner-occupied properties. These are for investment purposes only. That being said, if you are flipping houses and you buy with a hard money loan, and then midway through the project, you realize this is my dream home, I want to live in it, you are able to refinance out of our loan and then live in the property. Just don't be living in it while you have a hard money loan. Again, we don't want to give out 100% 100% financing, and we do want to see that you have above a 620 credit score. So people often ask me, hey, how do I get a hard money loan? How do I even get a pre-approved letter, or how do I get pre-qualified? So what you would do is you would just call a loan officer first. In this case, you would call me, or you would call Julius. You could also call, obviously, other hard money lending companies out there. Talk to a loan officer. They're going to ask you some pre-screening questions over the phone. They want to know two things: info about the property and then information about you. So information about the property usually only occurs if you have a deal that's almost under contract. Not something that you just happen to see on MLS, but something where like the seller is actually about to entertain your offer. They will want to know like the purchase price, the address of the property, estimated rehab costs, and estimated ARV. From this information, we're going to be able to know, first of all, is this even in a location we can lend in? You know, not every lender is licensed in every location, and not every property in these licensed states are good. Like, we don't lend in rural areas. So if you have property way out in the mountains, you know, it's something we probably don't want to lend on. Purchase price, rehab cost, ARV, that's going to let us know, hey, do you have a deal here, or is this something where you're going to lose money on? You know, we don't want to lose money, but we also don't want you guys to lose money, right? So we want to make sure you guys are doing good deals. And information about you is also going to determine how much we can let you borrow. So we're going to want to know your estimated credit score. We want to know how much you have in liquid funds, as well as your prior experience. The way that our company counts experience is we look at properties that are on title over the past 3 years. So how many deals have you actually done? Now, unfortunately, that means that if you're a contractor who've just done a lot of projects, but it's not your own, or if you're a wholesaler where you just wholesale deals all day long, but you never actually held title, those don't count as experience for our company. But on the off hand, like rental properties do count. So if you have a lot of rental properties, you haven't flipped them, at least you have experience as a real estate investor. And, you know, again, because you want to make sure you're successful, we need to make sure that you have enough liquid funds to cover down payment, closing costs, rehab costs, and 6 months of holding costs. If you don't have that, then it's likely that you're going to run out of funds in the middle of your project, and we don't want that to happen either. So that's why we can't just write everybody a $10 million like pre-approval letter to just go nuts and buy Hillsborough properties. It has to be within reason that you can do the project. So people also ask, hey, what do I need? What documents do I need to prepare? As a loan officer, I'm not going to handle your paperwork. Our processing team will. And don't send us these documents until you actually have a loan live with us, because otherwise it's too many documents that we don't want to mishandle. Basically, step one, we are going to do a credit check on you. So, you know, unless there's a really good reason why we won't do it, just expect to get your credit pulled. If you're going to be buying through an LLC or other kind of corporation, we're going to need to see those documents. So we want to see those articles of incorporation. We also want to see the operating agreement, and that will show like who's a managing member, who owns how much % of this LLC. We do want to see those bank or financial statements. So if you have investments, stocks, we want to see those. We want to see your driver's license or ID. Obviously, the purchase agreement. When you get the property under contract, it's likely the seller or you will open up escrow, and the title company will do a prelim on it. So we need to see that prelim report. We also do want to see your insurance contact. Generally speaking, it's not going to be like a Geico or Farmers person. It's going to be someone that specializes in flipping houses. We do have contacts for that as well. So don't worry if you don't have an insurance contact that specializes in flips. And we also want to see a scope of work. We want to know what you're going to do to the property. But you notice here we don't need W-2s or tax returns, which is really nice. So this next section is about construction loans. So sometimes people want more leverage and they want to fund their rehab project. So the first thing we're going to need is a scope of work from your contractor. A scope of work is a line-by-line description of the work and the costs associated with each job. If you are getting a construction loan, we're going to take that scope of work and send it to a third-party company to do something called a feasibility study. The feasibility study will overview and make sure a contractor isn't writing crazy numbers. They're not ripping you off, and they're also not underbidding like crazy. Because we know, right, if contractors write really low just to win your bid, and then they upcharge you later, then you're screwed. So it's basically like an appraisal on the scope of work. And then finally, the draw process. So let's say you have a budget of $100,000 for a rehab project, and we're funding 80% of it. We're not just going to give you $80,000 at closing and say, here, Tom, here's 80,000 bucks, good luck. It's too much risk for a lender. You could just go and gamble it away and lose the money. So the way that we pay you is through a draw process, what you do is you do the work first, and you kind of break up your scope. You break up your job into different milestones. And as you complete each milestone, you call our team, you say, hey, I completed phase 1, send a guy over. An inspector will come to your property, take a look around, take photos, and they're gonna just verify that you did the work that you said you were gonna do. If that's correct, and our construction team reviews all photos and invoices, we're gonna then wire that money back to you. And in this case, if it's an 80% loan, we'll then just wire you back 80 cents on the dollar that you spent so far. And we just keep doing that all the way through your project's complete. So here are some of the costs associated with getting a hard money loan. In general, right now with this environment, interest rates are gonna be between 8 and 10%. So again, this is an annualized interest rate. So you're not paying 8% every month. It's 8% divided by 12. Origination fees are gonna be around 1 to 2% upfront. So if you have a $100,000 loan, then your origination fees of 1% is $1,000 that you pay upfront. You're likely also gonna have to pay processing fees. So they're typically gonna be between $1,000 and $1,500. Again, because you guys are from this group, and you call me, let me know that you came from Tom's group, we'll make it down to $999 for a usual $1,500. Some companies also charge an appraisal fee on top of all this. And our company, we kind of wrap in our BPOs, or broker price opinions / appraisals, into that processing fee. If you are getting a construction loan, then you are going to pay an additional $650 for feasibility studies. In some states, they don't use title companies, they use attorneys, and it makes the real estate process a lot harder. And so that's why we have to upcharge a little bit more for legal fees as well. That's going to be another $700 or $1,000. That's usually going to be in states like Texas, New York, New Jersey, etc. So servicing fees. Most hard money lending companies don't do their own servicing. They like outsource it to a Shell Point or Fay Mortgage. And that's basically where they collect the money from you guys and then pay the investors in the back end. So that's going to be around $15 to $100 per month. And that scales with your loan amount. So if your loan's really small, then you're paying $15 a month. If your loan's really big, then you're paying $100 a month. So draw fees. Remember I told you every time you break out your milestones and you have an inspector come through, it's not free. You do pay $265 per draw. So that means that you can have as many draws as you want just to get paid back ASAP, but just realize that every time you do a draw, you are paying that fee. So most people are doing draws like 2 or 3 times for the entire project. And some companies also have a prepayment penalty. So Conventus does not, but I know when I did my first loan, I had one, and they usually charge 4 months of minimum interest. So what this means is even if you finish your project in 1 month, you still owe the hard money company 4 months worth of interest. And of course, if you sell by month 5, then it doesn't matter because you already passed that 4-month mark. All right, so here's an example of a deal. Let's assume your purchase price is for $500,000, probably somewhere in Hayward at this point. In this case, for 80% LTV, your loan amount would be $400,000. So $400,000 is 80% of $500,000. And let's say your interest is 8.5%. So to calculate your payment, you take 8.5%, multiply that by $400,000, your loan amount. So that's $34,000 a year. Divide that by 12, and that's $2,833 per month. If your points are 1 point, then that's 1% of $400,000, so it's $4,000. Processing fees of $1,500 because they're not from Tom's group, so they have to pay more. And imagine servicing fees of $30 a month, and your project time is 4 months. So calculate how much you have to pay for this hard money deal. You add in your fixed cost, which is your points, 4,000, plus 1,500 for processing. Okay, and then you add in your monthly rates. So that's 2,833 plus $30 a month, and then multiply that number by 4. And your total cost is 16,953. So yes, it may seem expensive, but just count this as a cost of doing business because this enabled you to do the deal in the first place. All right, so that was a quick primer on basic hard money loans. Tom, should I just keep going through and get this done ASAP, or should I leave a little break for people to ask questions on bridge loans?
Let's see. Maybe let's just knock it out with the long term, and then we'll do Q&A on both sides. So let's talk a little bit about long term.
So this is actually pretty exciting. So long-term rental loans are this new program that came out about a year ago, and again, it enables people to get 30-year fixed loans. We've been wanting this program for a very long time because in the past, like I mentioned before, with debt to income ratio, even though you have a great job, even though you have more rental properties, at a certain point, you might have too many loans and the bank won't give you more. Or after you get past 10 loans, you're donezo's. On top of that too, some of us are full-time real estate investors where we don't have stable W-2 income, or we're entrepreneurs, or even worse, right? As a real estate investor, we take depreciation. So it makes it look like we make even less money than we actually made because we don't want to pay taxes. But that hurts us, right? Because now the government says, oh, this guy made no money, right? He paid no taxes. So therefore, we're not going to give them a loan. It's weird. So the long-term rental loan program changes that because instead of looking at your personal income, your W-2s, your tax returns, your debt-to-income ratio, we look at the property's debt service coverage ratio. I'll go into that a little bit more in another slide, but this long-term rental loan program is great because it gives you a 30-year fixed loan. Like some commercial loans that I've done personally are only 20-year loans, so the payments are higher. Or they're like just 5-year terms, so after 5 years, you have to refinance. And what happens if you're in a crunch in year 5? You're screwed. This is a 30-year fixed loan. It's going to be there for your whole life, basically. The rates go as low as 4%, and these are great for purchases and refinances of rental properties. So there's 4 kinds of long-term rental loans. All of them are 30-year loans, but the way the interest rates are different is based on this graph. First one is 30-year fixed rate. Very simple. You have a fixed interest rate for 30 years, doesn't change. One's a 5-1 ARM and a 7-1 ARM. That stands for first 5 years are fixed, and then the rate changes every 1 year. So that's why 5 and 1. Same thing with 7 and 1. The first 7 years are fixed, and then every year after that, it changes. And it's again based on some index. Then finally, you have a 10-year interest-only version. And this one is probably the most interesting one to me because it's still a 30-year fixed loan, except your first 10 years are interest-only. So you can massively boost that cash flow. And then, of course, you're paying off the rest of the loan in the next 20 years. So then your payments go up a lot higher. But after 10 years, supposedly your cash flow is a lot higher, right? Let's hope. Let's hope you're not getting the same rent after 10 years. So again, this one's really interesting and a lot of clients really like this option. Okay, so how do we calculate debt service coverage ratio? And how does it determine if we can do your loan in the first place? So we only lend on cash flowing properties. Unfortunately, this means that it's kind of hard to do deals in the Bay Area unless you have a lot of equity in it and your loan's really small. The way we calculate it is you take your gross rent. In this case, let's say your rent for this property is $1,500. And then we divide it by something called your PITIA. You might have heard of PITI, which stands for principal, interest, taxes, and insurance. A stands for association dues, if it's in an HOA. Basically what this says is if your rent divided by your PITIA is over, let's say 1.15 in our case, then we'll do the loan. The lowest we can do is 0.8. But if your DSCR is less than 1, it means that no matter how efficiently you run this property, you're going to lose money, right? This is a gross rent number. It doesn't include property management fees, it doesn't include utilities, it doesn't include other costs. And your expenses, no matter how efficiently you run your property, you always have to pay this, no matter what, right? There's no way to lower your property taxes, your insurance, your HOA dues, or your mortgage payments. So we want to make sure your property is cash flowing, and that's why it's been hard to do them in the Bay Area. But yeah, in this case, you can see here, as the example, if this is your expenses, just add all this up, it ends up being $1,257. If your rent $1,500, then you take $1,500 divided by $1,257, and you get a DSCR of 1.19. So then this would qualify for our program. Another thing that's different about this particular program is there's generally going to be prepayment penalties. So like I mentioned, on the bridge side, we have no prepayment penalties. You want to sell in 1 day, I don't care. For this one, by default, it's 3 years. So we don't want you to sell or refinance this loan in 3 years. Now, some people plan on holding on to rentals forever. And that's when I encourage them to go to this 7-year minimum interest version. That will lower 0.5% off of your interest rate. There's a lot of ways to tweak your rates with this long-term rental loan program. And this is how prepayment penalties are usually calculated. It's usually in a step-down basis. So if you're in a 3-year program, 3-year prepaid penalty program, then in year 1, you're paying 3% of the loan amount as a penalty. Year 2 is 2%, year 3 is 1%, and after year 3, you're done. 5-year program, same thing. First, year 1, you pay 5%, and then 4%, 3, 2, 1, 0. And then you get to this one right here, 7 years of minimum interest. This is how you get the lowest rate, but this is also the harshest prepayment penalty structure. What minimum interest means is instead of just paying 1% on year 5, you have to pay the expected interest for that whole duration. So if you're on year 6, then you still owe a full year's interest on year 7, which is like 4%. I know it's a lot of detail, but if you guys have more questions, you can ask me later. But only take this option here if you're for sure going to keep this property for over 7 years. All right, so how do you calculate the rate? This chart looks very confusing. So I look at this every day. It's easy for me to calculate it. But basically, your rates vary a lot based on your credit score and your LTV. As you can see, this is your credit score here, depending on what bucket you land in. And then when you look at your loan to value property, most people, when they first call me, they want the maximum leverage, 800, and their credit score is maybe not so good. And then you see this number, 6%, and they're like, whoa, I don't want to do this. I can't blame them. I rarely do loans at this kind of tier. Most of my clients like to do 60% or 65%. And then, depending on the credit score, this is where you start. Like say 5% here. And then you go down here to these rate adjustments. These rate adjustments are also where we tweak the numbers a little bit depending on like your DSCR, it drops the rate, or what's your loan size. Are you doing cash out refinance? That changes numbers too. What's your prepayment penalty like? And not shown on this chart is buying down the rates. So it's a lot, and we don't expect you guys to look at this at all. So if you have a question about your rate, just call me. I'll do a calculation. It might take me 2 minutes to just figure this out. Now there's some limitations here. Obviously, again, not for owner-occupied properties, has to be for investment purposes. You need to have quote-unquote experience for this one. On our bridge side, we don't care. You're new, we'll give you a loan. For this one, you have to have owned a property in the last 2 years, otherwise you don't qualify for this program. What you can do though, is you can buy this property with a bridge loan and then refinance into a long-term rental loan program. But we can't just have you buy a property and you have no experience. The property needs to be in livable condition too. So what that means is, like I mentioned in the last couple of slides, where hard money loans are great for properties that are messed up, not the case for long-term rental loan programs. If the property needs work, then buy it with the bridge loan first, fix up the property, and then refinance into long-term rental loan later. This loan is also only good up to 8 units. So from 1 to 4 units, 1 to 8 units, we can do it. And generally speaking, we have a $75,000 minimum loan minimum, although we prefer $100,000 for your loan minimum, and a 660 credit score, so it's a little bit higher than a bridge loan. All right, so this is seasoning period, something that people should know if they're trying to do the BRRRR strategy. So if you're trying to refinance between 0 and 3 months, your max cash out refinance is capped at 70% of loan to cost or 70% of loan to value. From 3 to 12 months, your max cash out is capped at 100% loan to cost or 70% loan to value. And 12 months is 75% loan to value. And your loan to cost is taking your total cost of purchase and rehab. The loan amount divided by your purchase and rehab cost. So I know this slide's a lot. It'll be easier on the next slide when I go over the examples. So this is doing the BRRRR strategy with hard money, and a lot of my clients are doing this as well. So let's say, for example, you buy a property for $200,000. Your rehab cost is $30,000, and the ARV is $350K. So that means your hard cost, you're adding your purchase price plus your rehab cost, is $230K. So what's your loan amount? What can you pull out? So for month 0 to 3, you can only pull out 161 because that is 70% of 230K. From month 3 to 12, the max you can pull out is 230K because if you take 70% of 350, you get a higher number than your hard cost. So we're only going to be able to give you 100% of your hard cost, which is 230K. That's why it's here. And then month 12, we can give you 75% of this. So now you have 245. All right, so how do you get a cheaper loan? On the bridge side, having a higher FICO score, asking for lower LTV, more experience, and then doing repeat business with the same lender. All these things let us help you. We build a relationship with you, and then we give you a better loan with better terms. And of course, negotiating. So if you're calling me, and then you're calling Julius, and then you call me, and you call Julius, there's likely going to be a little bit of a little battle going on, and we might get you a better loan. Although, not gonna lie, it's really annoying, but it is what you got. You do what you gotta do, right? For the long-term rental loan program, that one's pretty fixed. There's not too much flexibility you can do there. So just having a higher FICO score, asking for a lower LTV, you can buy down the rate. For our company, if you pay half a point up front, then you lower your rate by 0.25%. If you pay 1 point up front, then you lower your rate by half a point. Sorry, 0.5%. And also stricter prepayment penalty. So they come with 3 years of default. And then if you go to five years, it's lower, and 7 years is lower. All right, I know it was a lot. Thank you so much for your time. Again, my name is Sean Pan. You can contact me at sean@everythingrei.com. My Instagram is I'm_Sean Pan, and check out the YouTube channel as well. All right, that's it, Tom. Sorry for taking up too much of you guys' time.
Nice, that was good.
Happy to answer any of your questions.
Yeah, very detailed, very informative, which is perfect to roll over to the Q&A. But before we do that, let's try to get a photo with everyone. Can we get a photo with everyone real quick? I'm trying to fit everyone on one screen. Is that possible? Full screen?
Gotta show your cameras, guys.
How do we do that? How do we view everyone on one screen?
You can't.
You can't? No?
No.
Oh, man.
I think 30 is the most.
30 is the most?
But you only have 27 anyway, so it's all good.
Yeah. I think there's some on this side, that's why.
Oh.
Yeah.
That's weird.
So let's do 2 screenshots. Okay, you guys ready?
Camera's
2
on.
screenshots. Give me your best smile. All right, big smile, thumbs up. All right, there's one. Okay, one more. Let's do one more. One more. Some people getting me the photo twice. That's lucky. Okay, one more. One more. 1, 2, and 3. There we go. Thank you. Okay, so now let's go over. Go back. Oh, there's some weird sound going on. Okay, let me share screen again. I think we have to mute someone. Okay, there we go. Awesome. All right, so now is the Q&A. So Conventus and Julius and Lending Home, they have similar products, but there's always something unique, right, about each one. So let me pull both websites. So first Conventus, and then Lending Home. So you can see what each company looks like. Lending Home, right? Lending Home. Okay, so Conventus and Lending Home. Where is Lending Home? Right here. So Conventus and Lending Home. So first, who has a better website? Conventus?
Better be nice. Brenda made that website, Tom.
Really? Brenda? Dang, I didn't know
it.
Brenda can make websites. And then look at Lending Home. Who has a better website?
Yeah, we had a marketing department put that together. So.
You got a video. That's high tech. Look at that. And you got, is this
Yeah.
Lending Home? What is this yellow line? Or is that Zoom or something? There's a yellow line on my screen for some reason.
Yeah, I don't think that's
Yeah,
us.
Zoom.
I think that's you.
I think someone's like drawing on your screen, bro.
Very nice. Okay, so very good websites. Brenda did a fabulous job. I'm gonna hire her to make my website too. Very nice. So now let's roll into the questions. How do I get rid of this yellow thing?
Were you with a blonde last night?
I think so. There's a blonde hair in my screen. Okay, no problem. So okay, I'm gonna mute some more people. Okay, Julius, you want to talk a little bit about Lending Home? And is it okay if we go a little bit longer today, 10:15, 10:20, since today's.
Yeah, I'm good.
Yeah. Okay.
I don't
cool.
have anything to do either today. So.
All right. Quick spiel on Lending Home. What's the best thing about Lending Home and all that?
Yeah. Hey everyone, my name is Julius. I'm the regional director for Lending Home. So I'll give a little background about our company and then what we're striving to do, and then we can kind of go into the Q&A.
Mm-hmm.
But if you scroll down a little bit, you'll see some numbers on what kind of volume we're doing.
Wow.
So we've been around for about 7 years now and originating for 6. And I've been with the company since its infant stages. I think I was probably like the 50th employee. So I've seen where it's come from. It's 10 million a month days to now we're doing about 300 million in volume every month. 260 million of that is for bridge loans. So bridge loans for fix and flip, cash out refi, or just short-term financing in general until someone can find a more permanent solution for the property if we're trying to hold it. So 260 million of that each month is fix and flip, and then 40 million is rental loans. So we'll do both. We could be a one-stop shop for both. We really try to strive to provide financing that's simple, reliable, competitively priced. And then one big part that makes our loans streamlined is our technology. So you'll see the sign-in button on the top right. We have an online portal where you can go to price, submit, manage your deals, keep track of everything. Everything's done in-house and managed through that portal. So not just on the front end for the user that's submitting their loans to upload full apps in 5 minutes or less, but also for us on the back end when we're originating. So for us, Sean mentioned in his presentation that, sometimes lenders will outsource for servicing or processors or underwriting. So at Lending Home, everything's done in-house. So everything from initial submit to processing to underwriting, doc drawing and servicing, we do all that in-house too. So with that portal, everyone's working on that just to get the deal done simply and as quickly as possible. So I think that's one big thing to call out for us that's a big advantage for us is the origination platform. So yeah, again, Lending Home, we're doing bridge loans, rental loans, and we're backed by technology to help streamline and scale it pretty much.
Nice. So Brendan's gonna build a sign-in login for Conventus now. That's
Good,
cool.
sure.
Very cool. So very big company and lend in a lot of states. So I think Lending Home lends in more states than Conventus, right?
Well, we're in 28 states. The biggest states that we lend in are California, Nevada, Texas, Florida. Those are some of our bigger volume states.
Yeah.
So North Carolina is up and coming too.
Nice.
So
You guys do Arizona?
Yeah, we do Arizona as well. So we funded about 1,000 loans last month. So
Wow.
like 200 of those were California, and then like Texas, Nevada, Florida, North Carolina. Those are like 50 loan states.
Yeah.
So just if anyone wants to get an idea of where there's more action, those are some of the bigger states. So
What about you guys, Sean? How many states you guys lend in?
I think we're like 30 something states, but we're not in like Arizona and Nevada. And I know it's like a huge one.
Yeah.
It was crazy because I was at like Ryan Pineda's thing with Sharon, and then like he's all about Lending Home. And I'm like, I can't help you, bro. Sorry.
Yeah. So Lending Home got Arizona and Nevada. If anyone wants to expand out there, okay, very nice. Thank you for the intro. And then I had some questions and very quick questions. Sean probably went over a lot of it, but we'll compare side by side. So processing fee with Conventus was $1,500, right?
I'll do $999 for you guys. But usually it's $1,500.
$999. All right, $999. Can we get any lower? Can we get it to $500 somehow?
Is it an auction? Depends how good your loan is, honestly. If it's like a really good loan, you're a really good borrower, then like I think these are negotiating points.
Okay, it depends. It depends. Okay, and then Lending Home processing fees.
Yeah, so also depends on relationship, type of borrower, first timer, or someone's doing 50 a year, and of course negotiating, right?
Okay.
This is all about in real estate, there's a lot of negotiating that goes on.
Yeah.
But for us, it's anywhere from $499 to $1,500.
Okay, so about the same.
Mm-hmm. Yeah, so I mean, I think Sean may work the same way with you, but a lot of those fees go to things that are involved with originating the loan. So like the third party stuff, like fees that go elsewhere.
Yeah.
So that's probably why the fees are pretty similar in general.
Okay, so it goes to the third party. So you guys don't collect that at all. Does not go into your pocket.
For example, like we have a program called Bridge Pro, and in that program, before closing, we don't go in the house before, but we do an appraisal afterwards.
Yeah.
So the fee, like part of that fee goes towards that appraisal.
I see. Okay, towards the appraisal. Afterwards,
right? Not before.
Okay, very nice. So fees are about the same. So it depends on how you negotiate your experience. You can get it down. And then down payment with Sean went over a little bit about that. So Conventus can do 10 to 20% down depending on experience and all that. Lending Home also 10 to 20% down, right?
Yeah. So we'll go up to 90% of purchase, 100% of rehab. ARV cap is 75%.
Yeah.
One thing I think that's important to call out though, like if anyone out there is working with private money lenders, in conjunction with their hard money lenders, with us, we actually do allow for second lien positions behind our first.
Okay.
So if someone's trying to use gap funding to bridge that gap, we allow it.
Yeah.
The second has to record the day after our first to ensure that we're in first position.
I see. Okay, nice. So second has to record the day after, and then with Conventus, if there's a second, what does that process look like, Sean? if there's a
You
second?
know, most of my loans, like I haven't done one yet. I think if there's a second lien position or even like seller financing,
Yeah.
I think we limit total loan cost to be 85%.
Loan cost to be 85%.
Yeah. I mean,
Okay.
again, unless you're super experienced
Yeah.
and you have a working relationship.
Okay. So a little bit harder to get the private money loan on Conventus side, but unless you have experience, then it's okay. But if you're new, it might be harder, right, to get second loan positions.
Yeah, because we want to see skin in the game.
Yeah.
And then usually what happens is they just partner and then it's all good. So
Yeah.
like they partner together, they're on the loan, and then they split the equity however they decide.
Oh, that's true. If you have a partner with experience, that's an easy way to get the second loan position. So just partner with us, Dean, or add more co-signers. How many co-signers can go in the loan?
However many wants to sign.
Okay, 100 of us are gonna co-sign the next deal together. Can we do that? And get the
Oh my
best.
No, that's no.
Honestly, it's 5, right? I think it's anyone that owns like 20% or more.
I see.
Who's like
Okay.
the major, right? Everyone else is like minor and it's not much.
25 for us. So very simple.
Yeah.
25. Okay, we're gonna have 25 people sign those loan docs. It's gonna take
Yeah.
5 days.
25%.
So we could have as many co-signers as possible to get that best rates and to get the second loan position, because it is a little bit complicated with second loan positions, but it's very doable. You could. That's how you technically raise 100% financing by.
Yeah, and for
Yeah. Go
and
ahead.
for anyone that has for anyone that does have complicated entity structures, like we're pretty good at
Yeah.
at navigating through those. So
Oh.
sometimes some lenders will struggle with it.
Yeah.
But we gotten pretty good at it. So
Okay. Nice. So Julius likes complicated structures, and he
I didn't say I like it, but
nice.
makes
Very
things
nice.
interesting.
Oh, question. So can we buy a property with hard money under a trust?
Yes. You can.
Nice. Nice. Is that for both
Land trust,
conventions?
common law trust.
Yeah. Nice. So land trust, all that. And then convention, same thing. You can buy under a trust.
You can definitely buy under a trust,
Yeah.
although I think land trust is one of those any types we can't do.
I see. Except land trust. So I don't know the difference. There's a whole bunch of trusts, like irrevocable, revocable.
Yeah, I think it just
Trust.
depends on like your, like, honestly, what it comes down to is if you mess up,
Yeah.
like, I think it's harder to get things back from a land trust.
Yeah.
You know what I mean?
I see. I see. Okay.
Yeah.
So any type of trust except for land trust.
With an
Yeah.
asterisk.
Yeah, for us, irrevocable trust is the only one we can't do.
Irrevocable.
Irrevocable.
Oh,
Yeah.
okay. Can't do. So
Because
the
there's, I think it has something to do with like if the trustee were to pass away or the beneficiary,
Mhm.
then it makes it impossible for us to, in the event of default,
yeah.
like it makes it impossible for us to try to make ourselves whole.
Yeah.
So that's why we can't do that one.
Okay, okay. So that's interesting. I wanna learn how to buy properties and trust, things like that.
Sure.
Okay, so rates. You guys heard about the rates earlier. It could range from 8 to 10% for the rates. I guess what is
So-
the yeah? Go ahead.
So with lending home, if you're talking about bridge loans and like fix and flip,
Mm-hmm.
it's a 12-month term by default.
Yeah.
It's interest only, and there's no prepayment penalty.
Yeah. No.
So you could
prepay.
use it. Yeah, no prepay. So you
Nice.
can use it for transactional funding. And if
Yeah.
you decide you want to wholesale it,
Yeah.
it's all good. You only pay interest for how long you hold it for.
Right.
Rates will depend on experience, down payment, and then it's anywhere from 6.5 to 8.5 for us.
Yeah. 6.5 to 8.5. So it could get to low as 6.5. So it's kind of like a rental loan in a way, kind of. If you can have.
It can be. We actually have, to your point, we have as is value bridge loans
Yeah.
where they're anywhere from 6.5 to 7.5.
Nice.
That's 1 to 2 interest only.
Yeah. Very nice. So the rates can get very competitive. So when you're shopping rates, you can get down 6, 7. But it's all about that experience, right? That's one of the key things.
Yeah,
Experience.
experience, LTV.
Yeah.
I mean, from a lender standpoint, if you're less risky, then they're okay with taking a lower coupon, right?
Yeah.
If you're more risky, they have to take on the risk by charging more.
Right. Okay. And then co-signers definitely help, right? If you have more co-signers on the loan.
Yeah, so we'll do soft checks on the guarantor.
Mhm.
So if there's anyone on there that's okay with guaranteeing the loan and signing for the loan, then
Yeah.
we'll use that FICO score.
Yep.
FICO score is also a driver for interest.
Okay.
We only do soft checks, and none of our loans show up on credit reports.
Very nice.
So along with DTI on conventional loans.
Yeah, so soft credit pool, and then so you can get creative. So let's say if you just want a co-signer, but you don't want to put them on title, so it could be one LLC but two co-signers, right? When you get the loan, or do they have to be on title?
Yeah, so the entity will take title,
Mm-hmm.
and then you'll choose who wants to personally guarantee the loan.
Yeah.
We can do no personal guarantee as well if you have enough experience and some track record with us.
Yeah.
So we also provide non-recourse loans.
Okay. And then Conventus, do you guys have non-recourse and no personal guarantee?
Yeah. So non-recourse, again, it's a negotiating point. So if it's something you really need.
Yeah.
And then in general, though, we do something called the bad boy carve out. So what that means is even though it's non-recourse, if it turns out you've been doing some stuff with like fraud,
Yeah.
then even though it's non-recourse loan, because of the bad boy carve out, we can still get stuff back.
I see. Okay. So you do something illegal or something like that.
Basically, if you're doing some fraud stuff, then your non-recourse is no longer valid.
Gotcha. Okay.
And just so people know, just for anyone out there that may not be following like what recourse and non-recourse is, basically if you're personally guaranteeing a loan and then let's say you go to default, let's say you can't pay a lender back, and say it goes to short sale or foreclosure sale or whatever it is, and we're not still fully whole from the loss, then the lender will technically go to the entity first, right, to try to make themselves whole, and then the personal guarantor. But if there's no personal guarantor, then it kind of ends there. But even so, like a lot of lenders will stop at the entity anyways, because the legality and the fees and the publicity go like towards going after a guarantor that hard isn't even worth it for the lender in all candor. So
Yeah. Okay. That's pretty interesting. So we went over FICO score, and then third-party funds. We went over that. So you could have third-party funds just recorded the day after, or co-sign with an experienced person. Long-term programs. We went. Sean,
I want to make a quick point on third-party funds. So I've had some borrowers, and they're new, right? They didn't know what was going on.
Yeah.
And they had funds, right, in their account. So when we looked at them, they're all good. But then at closing, when they wired the rest of their down payment, they had their mom do it. So that was like all bad because it's like, oh shoot, it looks like it's a third-party person not related to the transaction.
Yeah.
So that almost killed the deal. Luckily, we were able to make things work, but
Yeah.
don't do that. Like, don't be having some other person come out of nowhere, putting the money and wiring it directly to escrow. If you need to do that, have them wire to your account first.
Yeah.
And then from your account, you wire it.
So don't.
yeah, works the same way with us.
Okay, so don't have third parties send to escrow. So don't tell your mom to send to escrow. Tell your mom to send the money to my account, and then I'll send it to escrow.
There you go.
Okay.
I mean, honestly, it's all about communication, right? So like whatever you're thinking of doing, just talk first, and then we'll let you know, like, hey, this is not something you should be doing.
Yeah. So remember that. Never ever have, ever have third party wire to escrow.
Yes.
Unless it's communicated and it's okay, and you're recording after or something, or at least communicate, right? Communicate that.
Yeah.
Yeah. Okay. So very nice. So long-term programs. Sean talked about his. Maybe Julius, you want to talk about your long-term programs?
Yeah, so I mean, similar to Conventus's program, it's an alternative to conventional. So we'll basically 3 main drivers to our underwrite for long-term programs.
Yeah.
And these are 30-year notes or 10-year IO, which converts to a 20-year AM after that.
Nice.
But you could use it either for purchase or refi.
Yeah.
We go off the as-is value though, so we do an appraisal for those. So if you're buying it, it's got to be, rent-ready finishes at least, because they're going to go off the as-is value.
Yeah.
We'll go up to 80% of purchase on those.
80%.
And then if you're doing the way that most people are doing it, because it is a 30 to 45 day close, so like most people will continue to just look for distressed properties. They'll buy them, they'll renovate them, and then refi afterwards.
Yeah. Because
that way, if there's more equity in the property, you often get a better rate that way.
Yeah.
That 60 to 65 LTV rates, like Sean was showing. And then you're not up against the close of escrow like date, right? Contract date. So you can just refi at your own pace. No seasoning for rate and term when you're covering the existing debt. you can wrap closing costs into the loan too.
Yeah.
So when you do the refi, you pay nothing at closing if you want. You can just pay it over the course of 30 years. Cash out, if you self-fund it or use other people's money for that, 4-month seasoning for that, up to 75% LTV. Now, if you used us first, like on a bridge loan, then you only have to wait 3 months.
I see.
So they give you a little, incentive to use us first on the front end. But yeah, rates very similar, anywhere from the low 4s to the low 5s, depending on FICO, LTV, and then that DSCR calc that Sean went over earlier. So those are the 3 main drivers to underwrite: FICO, appraisal, and then DSCR. Although there's no minimum DSCR, Tom, it helps you if the DSCR is higher.
Yeah.
So obviously, if like you're in middle America, cap rates are much better and the DSCR numbers are going to be much better than, let's say, here in California. I think we ran into a couple deals where it was under 1. We'll still do the loan if it's under 1 now, but it just affects the terms.
Yeah.
Because, often here in California, it's more of an appreciation play as opposed to a cash flow play, sometimes. So.
Okay, very nice, very nice. So I have a quick scenario, and then we can run to some Q&A if anyone has some questions. So let's say we buy something out of state. Let's say it's $400,000 out of states for this 4-plex, and then now it's worth let's say $800K, and then we want to BRRRR. So can we BRRRR that and take everything out? So let's say initially we bought it with $100K down and $300K loan, put in $100K remodel. Can we BRRRR that with the?
I would say yes, you can BRRRR it. Can you take everything out? You can take up to 75% out.
Yeah, up to 75% of the new value. Of the new
value, correct.
Yeah. So 75% of 800K, how much is that? 75% of 800K.
600.
600.
That would be 600.
Yeah. So 600K. So we put in 400 and then 100. So we actually get an extra 100K if the value is there, right?
Right.
Yeah. So
yeah, there's 2 ways you could play it. You could go max cash out at the higher rate, or if you go lower LTV, it helps your rate.
I see. So this rate might be like.
I have a question. That 800, what is that based on? Is that based on cap rate, or is that based on something else?
Well, with Lending Home, when we do our valuations, we do it on a comp basis.
Okay, for 4 units.
Yeah. Correct. Yep.
Yeah, same here. It's a third-party appraisal. So for 1 to 4, you usually just do comps, and then for 5+, that's when they would do income.
Yeah. Okay. So comp value, and then higher rate.
The rate for that would be high, right? Because I don't know about you, Julius, but for us, like for multifamily, there's like a bit of an adder on top of it.
There is
cash out as well. So for 75%, that's like the max you can do.
Yeah. So
honestly, I would say it's going to be in maybe 6, high 6 or 7s.
Yeah.
So I would say when you're in that situation, because it does jump quite a bit from 70 to 75, so it often makes sense to just go 70. Yeah. Sometimes it'll be like a half a point jump on something like that.
Wow. So it's always safer to go 70%. Always keep 30% in there.
Like for example, I know off the top of my head, I was doing one the other day where it's 75 was 5 1/4, and then 70 was 4.75.
Yeah. So that's a big difference.
Yep, absolutely.
Wow. Okay. So always leave a little bit of equity. That way you get the best possible rates. What about commercial? Are you guys lending on commercial now?
We do not. So we play in the residential space only for now. So residential, non-owner occupied, 4 units or less.
I see. 4 units or less. 4 units or less. So nothing 5, 6, 7. We can't buy 100 units with you?
Nope.
Yeah. Okay.
Not with us.
So how does Grant Cardone buy?
Trying to hook you up there.
How does Grant Cardone do it? He buys 1,000 units. Is that
commercial lending, bro?
Commercial lending?
He doesn't use hard money.
That's hard money, right?
No, commercial's different.
Oh, I see. Okay. And then same thing with Conventus, no commercial, right?
We can do commercial.
Yeah.
So I think for like larger projects like that,
Yeah.
it's all like very bespoke. You know, we're gonna have to have many conversations before we can do it.
Okay, so a lot of research and a lot of.
For example, like we can do up to 8 units for a long-term rental loan program. No
Yeah.
problem. Up to 70% of purchase price.
Up to 8 units.
8 units. Yeah.
Nice. Okay, so up
Yeah.
to 8
And
units.
then for other multifamily, like on the bridge side, if you want to just like buy it, rehab it, whatever,
Yeah,
we can still do that too. I think 70% of purchase as well,
70% of purchase. Okay, so we need
or
30%.
70% of cost. So if you have rehab budget as well,
Yeah.
and then we've done like other ones too, like ground up development, new construction, and I even had proposed a hotel deal one time, but
Yeah.
those are like really low. If you're doing like new development and like
Mhm.
crazy stuff, it's gonna be in like the 50% range or something like that.
50% LTV.
Yeah.
Wow,
So
okay.
usually people buy the land first and then
Yeah.
come to us for the rehab budget.
Gotcha.
And, yeah, figure it out that way. But again, case by case scenario, it's not
Yeah.
guaranteed.
Okay, but that's good. Up to 8 units, and then lending homes up to 4. Is that gonna change anytime in the future? Because you guys have.
In the future,
Yeah.
because right now we're focusing on 2 new products that we're rolling out in Q4.
Yeah.
And those focuses are, one, portfolio loans. Because right now,
Oh.
for instance, we could do as many rental loans as needed. Like
Right.
we did a 50 pack in North Carolina recently,
Mhm.
but that was 50 closings.
Yeah.
Each property has its own loan.
Yeah.
So with a portfolio loan, you could wrap that all into one note. So portfolio loans coming out Q4, and then also new construction.
New construction, nice.
Do you guys have prepaid penalty as well, Julius? On long term?
On bridge we do not, but on rental we do. It's 3-2-1.
Yeah, so we have the same. One thing, I don't know if you had the same thing, but like if you have a portfolio and then they sell one property out of the portfolio, it triggers
Right.
pay on the whole thing. Is that the same case
Right.
for you guys?
It may be, but I've definitely heard of that. So that's one thing. One advantage of single asset is you don't have to worry about like those partial lien releases and prepays for that.
Yeah.
On the portfolio, it's something to look at.
That's why like I've never pushed my clients to do it just because I'm like, it doesn't even save them that much. It just saves on paperwork.
Saves on paperwork and process for sure. Yep, exactly.
All right, very nice. So a lot of competitive products. Anyone else have questions before we get ready to wrap up and send some mailers? Want to come over, Santa Clara? I'm gonna be in Santa Clara working on mailers today. We're gonna send out a couple hundred today. Corrado had a question, right? Corrado?
Yes, I have a question on the fix and flip for I'm just trying to compare. So, on the rehab cost, do we pay interest, for the money even we're not using, or we pay as as we go, as we do the draw? The other one is if you guys provide because I'm working with anchor loans too, where they do we don't make payments for the first 3 months. I mean, we still pay for those 3 months, but we don't make payments after the 3 months. Do you guys have something similar?
Can you repeat that setup with Anchor again? Just to make sure I understand it correctly.
Yeah, where we don't do payment for the first 3 months when we're doing the fix and flips.
Oh wow. Okay.
And also for the rehab money, do we pay interest all the time as even if we're not using, or we pay just as we go?
So when you don't pay for the first 3 months, you do your first monthly payment on the 4th month, and then do you pay the first 3 months of interest when you sell it, or when you pay it back, or when is that paid?
Yeah, so all that gets paid. Yeah. So we start. The first payment will start on the 4th month, but all the interest is paid. At the end. So.
Okay.
But just give us the leverage that we for the first 3 months we don't have to worry about making payment.
Right on. No, that's a nice setup. So we don't do anything like that as far as like the payments. We do charge every first of the month. It's auto debited from an account. You give us a voided check account, and then we just auto debit it from there. And then in today's world, for us, we do charge on the total loan amount for the life of the loan. So you are paying interest from day one on the rehab funds. But we're gonna change that soon. We're gonna have like a Dutch account where you're paying as you draw. So that'll be an option for experienced investors coming up soon. So,
Go ahead, Julius.
with Anchor, are they charging on the whole thing, or as you draw, or how do they do it for you?
Yeah, they're doing as we draw, or if it's like 100 or less rehab, they do like a credit line.
Okay, got it. Understood.
So for us, very similar to Julius, in general, we do charge interest on the undrawn principal. So even though you haven't like pulled it for your draw, you're still paying interest on it. And then again, usually we do have them pay month to month. However, there have been situations where we don't do interest on the undrawn, and also where we do wrap in like your interest payments for the first X months, towards your loan, kind of like as a second piece. So we would charge interest on that from day one. But again, generally speaking, like unless your project is really large, you're doing like a new development, $3 million construction loan, we would just charge interest on the undrawn. It's like $100,000 of loan. So, good question.
Very nice. Yeah, I like that. So Anchor has 3 months you don't have to pay, so that's pretty competitive. Everyone's getting super competitive, huh?
Yeah, but it's also based on experience and how many transactions that you do with them. Yeah, the same with Julius and Sean. They're not gonna give it the first time.
Yeah.
It's about relationship.
I remember
depends how good you can negotiate.
Yeah, I looked into that one with Anchor. They do want some more money up front, though. It almost sounded like they were taking out of one pocket and putting it in another. And I forgot what the terms were, but it wasn't.
Yeah, I mean, generally speaking, you're probably going to pay a higher rate or maybe more points.
Yeah, or they want. I forgot what the
or escrow funds, like, hey, put 3 months of payments in.
Yeah, it was something like that. It was something like that. Yeah, so it wasn't like a free lunch.
There's no such thing.
You're gonna pay either way. Pay now or pay later. All right, so it's 11:24. It's a little bit longer than usual, but we had a really good session today. So thank you everyone for joining. Thank you, Julius. Thank you, Sean. Very informative. So I'm gonna go find some more deals so I can give you guys some loans, and enjoy your Saturday. Unless you want to come over.
It's good seeing you guys, and thanks for having me, Tom.
Yeah, absolutely. Yeah. Absolutely.
Thank you. Yeah, thanks, John. Thanks, Julius.
If you guys want some pizza, come over. I'm gonna do mailers and pizza, so come over.
Mailers and pizza when?
Right now.
Oh man.
Mailers and pizza. Come over in Santa Clara. Everyone's invited.
See you in about an hour.
Okay.
We're in Santa Clara.
All right, we'll see you. All right, thank you everyone. Bye bye.
See you guys.
See ya.
Bye.